Debt restructuring for businesses for alternative finance. That's what we're going to talk to today with my guest, Marcus Uribe of National Credit Partners, the VP of Sales. Marcus, how are you?
I'm doing well, Shane. Thank you for
Thanks.
having me.
Yeah, thanks for joining me. I appreciate it. I think it's really an interesting topic. There's a lot of misconceptions out there with debt restructuring, debt settlement, for business debt out there. And we're going to talk about that and much more and what you guys really do and where you're going, with your business. So let's get right into it. What does National Credit Partners do?
Yeah, it's a conversation that I think is long overdue, specifically in the business debt management space. Like you were saying, I feel like there's a lot of misconceptions about whether or not it's a viable resolution and solution for businesses that are struggling. And so, what we do is provide debt management services to companies that are overextended, they're in a hardship, or they're experiencing a significant impact on their cash flow due to having multiple unsecured high interest advances outstanding at the same time. And what we're doing is we're providing a business debt modification or a true restructure, not a settlement. And I'll get into that later. But essentially what we're doing is we're modifying and restructuring the terms of these agreements with all of the business's lenders to ensure first and foremost that the lender is paid back in full, 100%.
Right.
Yeah. And secondly, we want to make sure that we're able to help improve the business's cash flow monthly. So we're looking for at least a 50% reduction on what they're paying collectively to all of their lenders.
Okay. All right. And so it's obviously a key point. I was saying, in full, right? So what else, maybe go into a little bit deeper of that versus, the other products or services that other companies might offer.
Yeah, absolutely. So it's important to ensure that we're able to make it very clear that this is only for businesses that are in a severe hardship. So they're either right on the verge of missing their payments, or more often than not, they're already missing payments. So they're in default, they're in collections, they're facing legal action, liens, etc. And so they really need someone to be an advocate for them and help them get back on track and keep the doors open, but also, ensure that they're honoring their financial obligations. And so we have a lot of brokers, ISOs, and even direct lenders themselves that will utilize us for our services because we're being mindful about the way that we're going about facilitating a resolution. And so I think that it's important to understand the difference between debt settlement and then a modification and restructure. And so I'm not here to disparage any companies or to speak ill of anyone. This is a product that businesses need. However, I want to be very clear that I understand why the business debt management space and product itself can be looked at negatively, specifically when it comes to settlements. And
Sure.
Not all companies are alike. Believe me, I understand that. But more often than not, the strategies that are utilized in order to facilitate a resolution aren't conducive to being amicable between both parties. And what I mean by that is settlements are structured in a way where a business would need to pay funds into an escrow over time, usually months, and then they need to accrue enough funds in that escrow account to make a lump sum offer to a lender. Now, if this business is already delinquent in some capacity,
Mm-hmm.
and a lender's not getting paid, then if it takes months before there's any correspondence or communication or even any attempt to pay that lender back, well, of course, it's going to lead to some aggressive actions on their end, rightfully so. It's within that lender's right to utilize those types of tactics, collection strategies. And so we don't believe that that's the right way to go about reaching a resolution for these businesses. So rather than waiting months for funds to accrue in an escrow account before we even make an attempt to contact the lender, and by the way, making a settlement offer 20, 30, 40 cents on the dollar may not always be a welcomed outcome for a lender as well.
Right.
So what we're doing is, based off of a cash flow analysis, we're underwriting a file for hardship. So we need to be able to show evidence of this business being impacted. And then what we'll do is reach out to a lender or creditor within 24 to 48 hours of a business's enrollment. So we're reaching out quickly. We're seeking to get ledgers verified so we can make sure that we're negotiating on the actual balances for each account. But we're negotiating for 100% payback to these lenders and right away. So as soon as we get new agreements in place for these businesses, we want to make sure that we're allocating funds to the lenders immediately. We're not waiting months to get this done. We want to make sure that we get them paid as soon as possible. And this ensures that we're approaching a resolution the right way. And I think it's important to have those types of discussions right up front. We want to make you whole. We want to make sure that you get paid back in full versus the alternative, which may not always lead to a solid outcome for the business and for the lender.
Got it. And there's some things that when the transaction, I guess, happens, when you do a modification, right? And just help me out where I haven't necessarily seen one lately, and certainly not necessarily from your company, but are there adjustments in the debit amount, and then does that affect the business going forward?
Sure. Yeah. So typically, like I'd mentioned, these businesses they're already delinquent in some capacity. And so usually they're already facing some sort of collection activities. They obviously were not able to adhere to the payments that they had agreed to make, for better or for worse.
Right.
It's just kind of where they are. And so we would seek to work out an arrangement based off of the business's cash flow. And we're talking about, what your average deposits are, what your average balances are, what your receivables look like in the near future. And we would use that to come up with a more affordable payment structure. So collectively, if a business owes $200,000 to 4 or 5 different lenders and they're in default with everybody, maybe they're paying $40,000 collectively a month, all on daily payment installments. Maybe we get that's reduced, let's say total by 50%, if not more. So instead of that 40, maybe now they're paying 20 or somewhere around there. And we get them out of the daily payments into something more uniform, like a deeply reduced weekly payment. And then we would use those funds and pay all of the lenders based off of the contracts that we renegotiated. So in that sense, there would be a revision to their payment structure. But again, important that we always are approaching these situations with the intent to pay the lenders back in full. And I also think it's important to note that the reason that lenders engage with us is because we're helping improve their bottom line. There's a file that's negatively impacting their portfolio, and that's costly. And it could potentially be even more costly if they were to utilize a third-party collection company, for example, that would charge fees for services rendered, or to go the legal route and pay for the attorney fees and all of that. So we believe that if we can expedite getting a new agreement in place and mediate this situation between the businesses that are delinquent and the lenders, ensure that the lender gets paid back in full and start to remit those payments as soon as possible, that's a win for everybody. And it saves money on the bottom line that would have otherwise been an expense for that lender.
Perfect. Okay. And so, kind of the next thing is the myths. We kind of mentioned that as far as what's out there. Talk to me about some of the myths and how either you guys are different or what's, really not true, and how you guys operate.
Sure. Yeah. I think one of the biggest ones is that a modification or a restructure would negatively impact a borrower's profile. And that's something that everybody's really concerned about, rightfully so. There are lenders that communicate via data merge, and I know that that's, something that's kind of a big deal. And what I would say is if you go the settlement route, you potentially are risking having negative reports on your business borrowing profile. The big difference here is that we are ensuring that everything is shown as paid in full, again, versus settle for less, and stipulating that in the agreements that we're able to put together. And so a lot of these advances don't report to the major credit bureaus, but even still, there are other ways of tracking who's delinquent, et cetera. And so by ensuring that everything ultimately is paid in full versus settled for less, we are able to quite confidently say that this business, once they graduate the program and honor their financial obligations, will be in a position of being lendable again. And I think that that's very important to distinguish.
Yeah, that's
Yeah.
huge. That's huge. That's really, kind of top of mind. Even, kind of referring back to my previous question, I think that's what business owners are concerned about. Obviously, one, they got to make whole with the advance or loan or whatever, that they have with the lenders. But yeah, they want to be able to set themselves up in case they need, capital again in the future.
Yeah, and it's important for the broker or the ISO that's working on that file.
Right.
This is a client of yours, and yes, are you able to monetize a decline essentially? Yeah, sure. There are commissions paid for this program, which by the way aren't collected up front. So we don't even charge upfront fees to these clients. We don't believe that would be ethical. So we typically collect the fee over 6 months, the first 6 months of their enrollment in the program, and we're on a revenue share model. So that way we're immediately improving the business's cash flow. We're working out agreements, and then we're collecting the fee in small installments over time. But the real opportunity here is, yes, you monetize that decline, but also we were able to save a business that was struggling the right way. We were able to help them keep the doors open. We were able to get them back in a position of financial health. And then when they graduate this program, because of the way that everything is structured, paid in full versus settled for less, they're going to be lendable. And now the opportunity to get them set up with a more comprehensive financial product it's much more viable, and there's a greater possibility of providing that business with that type of product because we've gone about this resolution the right way.
All right.
Yeah.
Great.
Maybe some other myths that I would say is that lenders won't work with an outside company, which is something that you'll hear. And for the most part, sure, that's true. They typically will not engage with a third party that, again, is not approaching them the right way. And so they'll have their own internal collection department usually, or they'll syndicate out to a third party, whether it be legal team or a collection company, et cetera. Again, the reason why we have these relationships and the rapport that we do with these lenders when we get involved is because we're approaching this the right way. We're not seeking to just knuckle them down for 30, 40 cents on the dollar. We're not encouraging a business to completely move, change their business entity, move assets around, go into default. We are only dealing with these situations when they're already in a position of being in default, being in collections, right? And then when we're engaging with these lenders, we're saying, hey, look, we know this is negatively impacting your portfolio and we want to get you paid as soon as possible. Based off of our cash flow analysis and the financials that we're reviewing, we believe that this might be a more affordable payment structure, and that way we can make sure that you're paid in full. And so that dialogue and that approach has vastly different results in a positive way. And so I believe that is important to consider when we're distinguishing modifications and restructures versus settlements, which may not always lead to an expeditious resolution.
Right. 100%. All right.
Yeah.
Anything else out there? Any other, kind of myths that brokers may just have in the back of their mind or anything like that?
Sure. Yeah, I would say that sometimes there are companies that will offer a restructure, and it's actually just a settlement in disguise. Not always, but I think that sometimes you hear these words and you're like, oh, I know what that is. When in reality, a true restructure or modification, it is structured in a way where payments are being made to these lenders immediately upon executing agreements. We're reaching out and communicating with them right away, versus taking months. And so I think that when you are looking for a home for these files, and when you're looking for a place to potentially reach out to get a resolution for these files that are essentially auto declines, right? I think that it's important to take note of how the program is being pitched, and encourage your clients to take a look at the agreements and the contracts. If you're looking at a pay schedule or a fee schedule and you see all of the payments that you're making in the first month or two going to program fees, that should be something that you should question. If you look at a payment schedule and you realize, hey, my lenders aren't actually, there's no offers being made to my creditors for months or until X amount of money is in an escrow account, and you're already getting phone calls or you're already getting emails, or your accounts are on hold or frozen with liens, or you have customers being contacted, again, that should be something like maybe a red flag, right?
Yeah,
And
alarms
so,
off.
yeah. And so I think that it's important to understand that not all products are the same, but if someone is speaking about a true restructure or modification, it should hit all of those criteria, that I had mentioned. It should be something that seeks to get a resolution in place immediately. And there should be payments being made to these lenders right away. And there should be an attempt to make that lender whole and that creditor whole, so that we can preserve those relationships. We're not encouraging anything of the contrary ever. And, it's important to us because we understand that we need these relationships to be as solid as possible with the lenders that we're working with. And we also need to be advocates for these businesses as well. If they want to make sure that they're able to operate and they're able to qualify for funding in the future, that they want to keep the doors open, then that type of individual is going to see value in paying back their debts in whole. And so we're here to educate them and help them execute the strategy and plan of action that we've put in place. That way everybody wins.
Got it. Yeah, that's huge. I mean, I think, I mentioned to you that's a lot of what you talked about is the image of what brokers have. Once they hear, oh, this merchant's had a debt, settlement or whatever, debt restructuring, whatever the word is, they tend to think it's only, one thing, right? And they don't know kind of the differences, the nuances, or really major differences in companies like yours and, the other options of services out there. So thank you for that. So I didn't really mention how long you guys been in business and where you're based out of, but tell me a little bit about that. And then where's NCP going?
Yeah. Been in business since 2009 and operating out of Orange County, California. And, I would say that the business debt management space, and even just consumer debt management as well, they're growing. And with banks tightening up their underwriting guidelines, programs like PPP and EIDL kind of coming to a close. And there's some other things out there that are great, but it's difficult for businesses that don't have this exceptional profile to get access to capital, traditional capital. And so we're seeing a lot of businesses that have to leverage capital from alternative lending sources, right? And that's good because they deserve to have access to these types of programs. But we've seen an exponential growth in not only the amount of debt that these businesses are carrying, but the amount of businesses that are getting in these situations where they're over leveraged or overextended. And so the average debt that we're seeing per client is about 250,000, right around there. And so there are a lot of parallels in this regard. Where I think that we're going is we're trying to differentiate ourselves in the business debt management space. So we're closely aligned with regulatory agencies that are very prevalent in the consumer lending space, which is regulated. And so we are creating a structure and operational procedures that mirror that, so that we can ensure that we're not only being compliant, but that we are going about facilitating resolutions in an ethical and responsible way. It's very important to us. And so I feel that in the coming years, we'll see probably some more regulations, I would imagine. It's just kind of inevitable. And so I think that if we differentiate ourselves now and we create these practices and we educate people that are in the alternative lending space on how beneficial this could be for clients and for the, the lenders and the brokers and ISOs as well. If we go about it the right way, then I think that where we will be in the coming years is a leader in this business debt management space.
Yeah, and with the economy right now, it's kind of banks aren't lending as much, or it's going to get a little bit tighter. Like you said, it's coming to a different time economically, but still a bright future for alternative lending. Businesses need capital. So, well, listen, Marcus, I really appreciate it. We're about out of time. If there's anything else that you want to let the audience know, please do.
Yeah, I appreciate it. I want to thank you for allowing us to be a part of your platform and to hopefully provide some additional insights and education to your colleagues and your network. And what you're doing, I think, is just it's going to have such a positive it's going to leave such a positive ramification in its wake, just on the alternative lending space. And I wish you nothing but the best of success. Appreciate you noticing Kobe back there. He's a hometown hero out here, but I think that it mirrors what we're trying to do here, right? And you have to work hard. You have to play the game right. You have to be responsible, and you have to look out for your teammates, and care about the people that you're interacting with. And I think that's what you get here. And you can charge a lot of points on a deal, or you can take fees up front, or there's all these different ways to conduct business, and to each their own. But when you're engaging with us, and when you're one of our affiliates and one of our partners, or when you're doing business with us, it is something that is of the utmost importance always. And the moral compass points north, and we take that to heart. And it's something that I'm very passionate about. And so I hope that everyone that listens to this, and if we have any conversations in the future, that that's what you're getting when you're dealing with us. We're going to take care of your clients, and we're going to make sure that we also do right by the lenders that we're dealing with as well.
Perfect. And so, yeah, I'll drop your contact information below the video, and feel free to reach out to Marcus and his team. Well, with that, thanks again, Marcus, and we'll talk to you soon.
Thank you, Shane. I appreciate it.
All right. Thanks.